David Smith, Fund Manager with Alex Crook on Henderson High Income Trust. Let's start with the falling oil prices. Is this affecting any of the underlying holdings in the portfolio?
Yes, well, as you would have seen, the oil price has fallen 40% in the last few months to its lowest level in the last 5 years, and invariably that's going to impact the big integrated oil companies in the UK, the likes of BP, the likes of Royal Dutch Shell. Their share prices have come under pressure, but I'm more interested in the indirect impact from the oil price falls. This could have a significant boost to consumer spending through lower petrol prices at the pumps. And I think, when a consumer has an extra money in their pocket, they are likely to go out there and spend that. And what that could impact is the funds holding in the likes of Marston's, pub company. People will invariably go out more for meals, to go out socialising with friends. And also in the retail sector, the likes of Marks and Spencer's that we own. Hopefully you will see that, the increase in consumer spending come through into their profits.
Now, you've had a bit of a theme on finding companies with the potential to grow their dividends. Are there any strong sectors in this regard?
I think there is. One particular one that we have been looking at is the financial sector. I mean, now that economies are normalising, balance sheets are much better, in much better shape now. You are seeing companies return dividend payments and increase those quite aggressively. One company that we've bought recently is Paragon, which is a specialist buy-to-let lender. They have got a very strong capital position now, coming out of the recession. And as you see the growth come through in lending to more professional landlords out there, they are becoming more comfortable in terms of returning that cash flow that's generated on the balance sheet back to shareholders. And you saw that in their recent results, where they upped the interim dividend by 25%. So we hope that can continue going forward.
Okay, more generally, we've seen some recent reports that have been showing Q3 dividends increasing year on year. Do you think this is a true reflection of UK dividends?
I think it is, actually. Corporate balance sheets are strong. Corporates do have confidence in the outlook for the economy going into next year, and that confidence has resulted in higher dividends. More recently, you've seen companies like Sage, the accountancy software provider, up its final dividend by 7%, and also in other sectors such as the bus and rail sector, Go Ahead, increased their final dividend for the first time in 7 years. So that confidence, that strength of the balance sheet is now flowing through into increased dividends.
Okay, finally, David, we've got a general election next year. Do you think this is affecting corporate confidence?
I think it has, actually. I mean, if you look at the returns of the UK market this year relative to other developed markets, the UK has certainly lagged, and I think that's a function of international investors being concerned about the UK election and what that could mean if there is an EU referendum next year. I mean, you'd also see certain sectors used as a political football in the build-up to May and the general election. The likes of utilities, no doubt banks will be on the agenda, and also the bookies are likely to be sectors which could be impacted. I think it's worth remembering, though, that over 70% of earnings from the FTSE companies are derived from overseas. So I think the impact could be quite limited, and actually any volatility in markets around May and the elections, I think we could look at as an opportunity to buy new holdings. Really.
David Smith, thank you.
Pleasure.